In this video, I want to talk about Google. I have it up here on the chart. It's another NASDAQ stock. NASDAQ has really outperformed the market over the last week or so. So I thought, let's find another NASDAQ stock because I am still bullish on the NASDAQ. Obviously, I could be wrong and my prognosis might not be right. And therefore, we need to also have some sort of management plan in place to limit any potential loss. Now, you can see that Google is at all-time highs. Google is an amazing stock. I mean, I'm very bullish on Google. My longer-term target on Google is around that $1,000. I think Google sometime next year can hit that $1,000 mark. So definitely worth looking at. Anyway, for the short term, I think Google can reach a target of around, I can definitely get to that $800 mark. And if you're looking at this chart, you can see Google right now is at 786.9. That's where it's closed on last Friday, just a couple of days ago. Now, when the stock closes at that level, you can clearly see where's that sort of next level that this stock's going to be pulled towards. Well, it's going to be that $800 mark. So I think Google can very quickly hit around that $800. So my target range for Google is between $800 and $814, okay? So I looked at a couple of different options that I want to walk you through. And I also want to say here that this yellow line here is what is the 50-day moving average. Now the 50-day moving average will act as a support line. You can see here that most of September, Google has been above its 50-day moving average. So I want to sort of manage this trade so that I can stay in the trade and have, a loss here, a stop loss level at just under this 50-day moving average. So basically, I don't want to be in this trade if the stock starts to trade back below 765. Okay, so we'll need to see if that's going to work out because I don't want to lose too much. I don't want to risk too much if the stock does in fact go back down, okay? So let's walk you through some of the options that I looked at. The first one that I looked at was the 772.5 call. And it was trading at around $1,800, okay, so $1,795. Now, I like this one because you can see here the break even is very, very close to where the stock is now. It's at 790.45. The stock right now is trading at 786.9, okay, so it's only a couple more dollars before I might break even. So I really like that particular setup. And if I scroll down and look at where does this position double, where can I make that 100% return on investment? Well, it's a very small 2.7% movement in the underlying stock. So if Google gets to above 807, then my position will double in value. So that's pretty cool. Okay, I think that's very cool. Now, I guess the only issue I have with this is that I've only got 14 days to be right. Okay, so it's a very short-term trade. If Google doesn't get to my break even, which is 790.45, I'm going to lose this entire investment. These options that I'm buying will be worthless. Okay, so that's very important to realize because it says here very clearly that my break even is at 790.45. Okay. So we need to manage this trade very carefully. And so what I want to look at is I want to understand, well, what's going to be my potential loss if the stock starts to trade back below that 50-day moving average, which as we can see here on the chart, that 50-day moving average is around here. And if I just bring up where that is on the chart, well, that's going to be somewhere around about that 765. So I need to manage this trade to around 765 because I could be wrong. Okay, the stock may very rapidly move up and hit our target, but of course the stock may move around a bit and may even come down a bit before it actually starts to go back up towards that target, or in fact may not go up at all and just come back down. Okay, so there's a couple of scenarios that we need to manage this trade too. So the first thing is that it may go up and hit our target somewhere above that $800 level. It may not do anything and it may just go sideways from here. Okay, now if we look at our risk graph, what happens if the stock goes sideways? Well, you can clearly see this blue line here marks the current price of the stock, which is 786.9. If the stock doesn't move and time just goes on, expiry is this black line, okay? Well, if time goes on, I'm going to be at a loss, okay? I'm going to be at a loss. So if I just sit in this trade and time goes on and I get to expiry, we're going to lose a couple $100, okay? Now, you can see in the chart also that if I actually am right in my prognosis and the stock actually does move up, well, as the stock moves up, okay, the stock price is here on the left-hand side. As the stock is moving up, this profit here on the right-hand side is increasing, okay? That's why this chart is moving to the right-hand side as the stock moves up. And that's why it's moving to the left side as the stock moves down, because to the left is a negative profit, which means we are at a loss, okay? So if I position my mouse somewhere around this 765 on the stock chart here, okay, I'm going to go down here, I'm going to find where 765, I'm going to go across. Well, at 765 or thereabouts, I'm going to lose almost $1,500, okay? Now it depends how long or how fast Google moves down to that level. That's why you got these three different timelines, okay? Each one of these lines represents 1/3 in time that I'm in the trade. Now, I'm only in this trade for 14 days. So each one of these is just only a couple of days apart, okay? It may be 5 days, maybe 5 days here in this blue line, in which case if the stock is down at 765, I'm going to lose about $1,355. If I'm 10 days in the trade, well, I'm going to lose a bit more because more of that time has gone by and those options have decayed further, okay? So that's something to be aware of, that, you know, we need to manage this trade accordingly. So I looked at a couple of more. I mean, the trade works out very nicely if we are right. But of course, we need to manage our risk. The problem I have with this trade is that while I only need to make a 2.7% movement in the underlying stock to reach my target, or to get a double in value for my option, my problem here is that because I need to be in this trade up until, even if the stock is as low as 765, because on the chart technically that's where I'm going to be proven wrong if it trades back below this 50-day moving average. So I really need to stay in the trade up until, even if it comes down just below this level, okay? Because I need to give the stock enough time and enough space to move around. So that's my only issue, that I'm going to have to potentially have a loss of nearly $1,500 just to be in this trade and stay in this trade as the stock moves up and down. So I looked at a couple of others, okay? This particular call option is very deep in the money, meaning that the strike that I've chosen here is lower than the current price of the stock. You can see the current price of the stock is 786.9, okay? That's last Friday's close. Now you can see that the call option that I'm looking at is 772.5, okay? So it's in the money, okay? So it's very deep in the money, and that's why it has a very high entry cost as well. But the benefit of that is that the break even is very close to where the current price of the stock is, and the stock doesn't really have to move much, in this case only 2.7%, to reach a double in value towards that last sort of 1/3 of time remaining in this particular trade, when you only got about 5 days left in this 14-day trade, okay? But the issue here is that I've only got 14 days for these options to expire. Now that's okay if it's in line with my prognosis, okay, which it is. I think that for my prognosis, if you draw a trend line, the stock is moving up pretty quickly, and I think if we are going to be right, and if it is going to hit our target of that $800 mark, okay, then I think that's going to happen pretty quickly within the next 7 to 10 days. So a 14-day option seems pretty reasonable, okay. The other options that I looked at was, I then also looked at, well, what about if I don't go out to 14 days? And what about if I don't buy a deep in the money call, but I buy a call which is slightly out of the money, meaning that the call is above, okay, it's above the current price of the stock, which is 797.5 call, where the stock right now is at 786.9. And then, sorry, 792.5 is the one that I purchased, where the stock at the moment is 786.9, so still out of the money. And I had to pay almost $300 for that. But to reduce my cost of entry, I then sold a higher strike call option for just a bit under $150, giving me a total entry price of $147, okay? And it's just a 7-day trade. Now, if I show you the risk graph, which is the important component here, okay, then we look at, well, when does this particular position double? Well, it only has to move as half as much as the previous position. Remember, the previous position had to move, I think it was 2.4% or 2.7%. So 2.7% up to 807 for the position to double, where this one only has to move 1.2% on the same sort of timeline, and only up to 795. I should say not the same timeline, because these options expire in 7 days, whereas those other options expire in 14 days. Okay. So this is what I like to do. I like to just put on a few different positions as I analyze the one that I go with. So I like to analyze, as I said before, a deep in the money call option, an at the money call option, and maybe an out of the money call option. But in this case, I'm analyzing a few different types of positions just to decide which one's going to be the better in line with my prognosis. The great thing about this particular position is it's very close also to a break even, very close to the stock. So it's a break even at 794, where the stock right now is 786.9. So not too far away, and not too far away from the previous position that we looked at, the deep in the money call option. Okay. The only thing I guess with this is I wanted to then look at, well, what about if I went out to say 14 days instead of having a 7-day option? What about if I gave myself an extra week? What would that, how much extra do I have to pay? Is that more, am I more comfortable with that type of a trade? So I took the same position and I bought a bit more time. I bought the next expiry period, and you can see the cost is only another $40. So that's not a bad thing. The break even of the trade is almost the same, around that 794. I'm paying about $40 more to get into this position. And then let's look at the risk graph is almost the same. Let's look at where does the position double. Well, in this case, it doubles at 1.8%. That's still a pretty good, very low amount that the stock needs to move up for me to make a 100% return on investment. It's still close to where my target is. My target for this stock, Google, as I said before, is somewhere around 800 and 814. That's my target, okay? Let's draw it in here. It's somewhere around here, okay, at 800, and maybe that's a bit too big. 800 and 814. Yeah, that's actually right. Okay, so that's the target that I'm aiming for. Now, we also need to look at, well, what does it mean for us as we manage the trade? As I said before, I need to stay in this position all the way down to 765, okay, because that's where potentially this stock would go, okay, before it sort of continues moving up. And also that's where I'm proven wrong technically on the chart. So I'm going to then now look at the chart of the risk graph, and 765 is basically somewhere around here, and it's almost all of my investment. So with this position, I'm going to have to basically risk the entire position, because there's nowhere on this risk graph that I can say that For example, in other risk graphs, I would position the trade and only lose half. Well, in this case, because the position loses almost all of its investment at the technical stop loss level, 765, we're only going to be able to invest enough to the amount of contracts that is equal to how much we're willing to actually risk. Okay, so normally I would invest $1,000 and risk $500, but in this case, because we aren't able to take this position off at 765 without losing the entire investment, we're going to have to only purchase enough contracts to limit our maximum risk to that $500. So, for example, we may only be able to buy 3 contracts, okay, and we leave these 3 contracts on completely and not actually manage the trade. Okay, it's another way to manage the trade, essentially, because we can't find on the risk graph a point where we can actually take the trade off and still meet our management criteria. So therefore, when that sort of scenario presents itself, then what I do is I just invest enough so that I can just leave the trade on and not have to worry about it and not take it off at all. It either works or it doesn't. Okay, that's the difference here. So our maximum profit is $945, and that'll occur if the stock closes above this 797.5. So if we get to our target of that $800, then we would reach our maximum profit. And our maximum risk in this case is $555. Okay, it's our maximum investment and our maximum risk. It's also the risk that I'm going to manage this trade to, because the trade loses all of that amount at my level that I've identified to have as my stop loss level. That means I'm just going to leave this trade on and let it go down all the way as far as it wants to go, because I've invested only an amount that's equal to the amount that I'm willing to risk in the first place. Okay, so that's how I'll be managing this trade. So then I thought to myself, well, what about if I wanted a bit more time, maybe 21 days? So I looked at that option as well. Okay, so I just increased the expiry, went to the next expiry, and I didn't pay much more than the 14-day option setup. I'll just go back to one contract so we can see how much this position actually cost us. And it wasn't a big difference between 14 days and 21 days. So so it's 185, and you can see the 21 days. Now, even though it says 180 here, it's probably going to be around about 190 or 195, maybe another $10 more. It's just that the market's closed at the moment as I'm doing my analysis, and the pricing may not be 100% accurate. So I think we probably will have to buy this option for $8 and probably sell this one for $5.80. So I'll just adjust it just to see what it's potentially going to cost us, because it's always going to cost us a bit more if we're buying a bit more time. Okay, so it's just an estimate. We won't know the real price until the market's open. It's around about that 220 mark, okay, as compared to the 185 for when you're buying 14 days, and in this case we're looking at 21 days. So if I now scroll down and look at, well, where does this double? It's still within our target of that, 800 to 814. Although I do want to double closer to $800, okay? And I don't believe we need to have 21 days to be right in this particular position, because the stock has been moving up pretty aggressively, and it's had a bit of a pullback, and now it's sort of back moving up towards its major trend, and it's at all-time highs, and it's almost cleared this last sort of resistance level. Okay, so I think we have a good shot at it reaching this $800 mark. Okay, of course we could be wrong, as I've said, so we need to manage the trade accordingly. Okay, so I do like this 14-day option. I think it meets our criteria a lot better, and we would just buy 3 contracts, which would be in line with my own management plan. Okay, so then I thought, well, okay, what about if I sort of did a combination? Could I buy some additional call option and maybe sell a few additional call options? And I came up with a pretty cool looking trade, which was this one here, where I bought some options, I sold some options, and I bought a few other options. And again, it's a 7-day trade, and it was only just under $50 to get in, which is pretty cool. And if I looked at the risk graph, this one doubled in value the quickest. Okay, it just needed a small 1% move in the underlying stock for this position to double. Okay, and it doubles at around 7.94. Now it still needs to take a few days to sort of move. Okay, some time decay needs to occur in these options for this position to work, but it's pretty cool because the stock doesn't have to move a lot for this position to make some good money. But there's only one problem with this position. Okay, there's only one problem, and that is that I'm not interested in a $50 profit, right? So my double is going to be $50. I'm going to make $50 if it gets to my target of that $800 in the stock. So if the stock price gets to 800, you can see my profit here is going to be somewhere around about $65, depending on how long it takes to get to that target mark. I've only got 7 days, so if by the end of next week or mid next week, Google is trading at around $800, then my profit is going to be $65. Now, I'm not interested in making $65, right? So I need to buy at least 20 contracts for this position to be of any significant value to me as a trader. Okay, I need to buy 20 because I want to make at least $1,000 profit, right? So let me just do that. For me to buy 20, I need to buy 10 of these. I need to replicate this position, not 10 of these, 20 of these. 20 of these, I need to buy 40 of these, sell 40 of these, and then I need to buy another 20 of these, okay? And then that'll make my entry in line with what amount of money I want to invest, because I want to at least get back $1,000 in profit. Okay, so you can see I'm now investing $928, and now if Google by the middle of next week reaches $800 in its stock price, then I'm going to make about $1,300, which is pretty cool. But there's only one problem that you have with this type of trade. Number one, buying this many contracts is going to cost a lot of money in brokerage. Okay, this position is going to cost, this is 40, 60, 80 contracts, right, just to get in. Now 80 contracts is going to cost me around about $100. And then if I want to get out, I need to do the opposite. I'm going to have to do another 80 contracts. That's another $100. So just to get in and out of this position, it's going to cost me $200. And then what if I needed to make an adjustment, right? I need to buy some other options or close this and make an adjustment. So I'm potentially looking at $300 just in brokerage fees because I'm buying too many contracts. Okay, so it's all good. I mean, if the stock does, what we think it's going to do, if we had to spend $300 on brokerage to make $1,300 in profit, that's okay. But what if it doesn't work out? Okay, I'm still going to have to spend a couple $100 on brokerage fees to get in and out of this position and or make adjustments, right? I'm not willing to do that. And that's why I don't like these positions that are cheap, like $50 to get in, because it makes no sense, right? You're not in it to make a $50 profit, right? A $50 position means you need to buy too many contracts for it to make any sort of significant, to give you any sort of value back if you are right in your prognosis. So the risk graph looked fine. It's beautiful, but the entry is so low that you need to buy too many contracts, which isn't feasible. So then what I tried to do was I tried to widen the position and try to buy a bit more time as well. So now I was sort of spending $77 to get in. If I bought 10 contracts, well, that would be an entry of 770, which would mean a profit of 770 if the options doubled in value at the same sort of target. But then this position is a different risk graph. It didn't really offer any sort of double at my timeline that I liked. So I couldn't really find a good combination to go with. And I didn't really have a lot of time. I didn't want to muck around and continue analyzing. I just thought, well, in this case, buying the call spread sort of made sense. This 14-day call spread made sense. And, I would buy maybe 3 contracts to manage my risk at that $500 mark and potentially look to achieve a $1,000 profit by doubling my investment if the stock was able to get to that $800 mark, which is the target, which I mentioned down here. So that's the one that we are going to be reviewing for this case study. And we'll look at this now over the next couple of days to see how Google tracks. So we've got 2 weeks to be in this trade, and then I'll give you an update in the next video as Google makes its move over the next couple of days, keeping in mind that we're going to invest only 3 contracts in this case study simply because at that technical stop loss level of 765, the position shows that we're going to be losing 90%, 95% of our investment. So we can only invest as much as we want to risk. Okay, so we won't be taking this position off if it doesn't work. We're simply going to let it go to expiry on the basis that we're only putting up that amount of money that we're willing to lose. Okay, that's why we're only going to be doing 3 contracts. So hopefully I'll be able to get into this position tomorrow, Monday, when the market opens. I'll put the order in, and then I'll be able to give you an update on how this position has progressed over the next couple of days. So remember, as I always say, you need to know that trading is risky. You need to only use capital that you can afford to lose, and you need to always manage and understand your risk.